Introduction to Capital Budgeting. Welcome to the world of capital budgeting, where strategic financial decisions meet long-term planning. If you've ever wondered how businesses determine which investments are worth pursuing, then you're in the right place. Capital budgeting is a vital process that helps organizations evaluate and select projects that will create value and drive growth. In this video, we'll dive into the ins and outs of capital budgeting, exploring its benefits, steps involved, and how to make informed decisions. Whether you're an aspiring entrepreneur or a curious individual looking to expand your financial knowledge, buckle up as we embark on this exciting journey through the realm of capital budgeting. What is capital budgeting? It's a process that helps businesses determine where to allocate their financial resources for long-term investment projects. These projects can range from purchasing new equipment, expanding facilities, or developing new products and services. Capital budgeting involves analyzing the potential benefits, costs, and risks associated with each investment opportunity. The goal is to make informed decisions that will maximize the value of the organization over time. One key aspect of capital budgeting is understanding the concept of cash flows. It's not just about how much money you're investing initially, it's also about assessing the expected future cash inflows and outflows generated by the project. By considering these factors, businesses can estimate the profitability and return on investment for each potential venture. Another important component of capital budgeting is evaluating different techniques such as payback period, net present value, NPV, internal rate of return, IRR, and profitability index. These methods provide quantitative measures to assess whether an investment is financially viable or not. In addition to financial analysis, capital budgeting also takes into account qualitative factors like market conditions, competitive landscape, technological advancements, and regulatory environment. This comprehensive approach ensures that all relevant aspects are considered when making investment decisions. Capital budgeting plays a crucial role in helping organizations prioritize their investments wisely. By carefully evaluating potential opportunities based on both financial data and qualitative factors, businesses can set themselves up for long-term success in today's dynamic marketplace. The benefits of capital budgeting. The benefits of capital budgeting are numerous and can have a significant impact on the success of a business. One major benefit is that it allows companies to prioritize their investments based on their potential for long-term growth and profitability. By analyzing the potential return on investment, ROI, of different projects, businesses can make informed decisions about where to allocate their financial resources. Another advantage of capital budgeting is that it helps businesses identify and mitigate risks associated with new investments. Through careful analysis and evaluation, companies can assess the potential risks involved in each project and take steps to minimize them. This ensures that resources are allocated wisely and that projects have a higher chance of success. Capital budgeting also promotes accountability within an organization. By establishing clear criteria for evaluating investment opportunities, businesses can ensure that decisions are made based on objective factors rather than personal preferences or biases. This fosters transparency and fairness in decision-making processes. Additionally, capital budgeting enables businesses to align their investment strategies with their overall financial goals. It helps organizations determine how much funding is required for future growth initiatives while also considering factors such as cash flow, debt management, and shareholder value. Implementing effective capital budgeting practices provides businesses with a strategic framework for making sound investment decisions, managing risk effectively, promoting accountability within the organization, and aligning investment strategies with long-term financial goals. It is an essential tool for driving sustainable growth in today's competitive business landscape. The steps involved in capital budgeting can vary depending on the organization and its specific needs. However, there are generally 4 key steps that are commonly followed. 1. Identify potential projects. The first step in capital budgeting is to identify potential investment projects. This could include things like expanding production capacity, acquiring new equipment, or developing a new product line. It's important to consider both short-term and long-term goals when identifying these projects. 2. Estimate cash flows. Once potential projects have been identified, the next step is to estimate the expected cash inflows and outflows associated with each project over its lifespan. This involves forecasting future revenues, costs, and other relevant financial data. 3. Evaluate the investment. After estimating cash flows, it's necessary to evaluate the profitability of each investment opportunity. Various methods can be used for evaluation such as net present value, NPV, internal rate of return, IRR, and payback period. 4. Make a decision. The final step in capital budgeting is making a decision on which projects to pursue based on their estimated profitability and alignment with organizational goals and objectives. By following these steps systematically, organizations can make informed decisions about allocating their limited resources towards investments that will generate long-term value and growth opportunities. How to make capital budgeting decisions. When it comes to making capital budgeting decisions, careful analysis and evaluation are crucial. These decisions involve determining which long-term investments will yield the highest returns for a company. Here are some steps to help guide you through the decision-making process. 1. Identify potential projects. Start by identifying potential investment projects that align with your business goals and objectives. Consider factors such as market demand, competition, and industry trends. 2. Estimate cash flows. Once you have identified potential projects, estimate the cash flows associated with each investment option. This involves forecasting future revenues, expenses, and any additional costs or savings resulting from the project. 3. Assess risk. Evaluate the risk associated with each investment option by considering factors such as market volatility, economic conditions, and project-specific risks. This will help determine if the potential return justifies the level of risk involved. 4. Calculate net present value, NPV. Use NPV analysis to assess the profitability of each investment option over time. NPV takes into account both the timing and magnitude of cash flows by discounting them back to their present value using an appropriate discount rate. 5. Consider payback period. The payback period is another useful metric in capital budgeting decisions as it measures how quickly an investment recovers its initial cost through generated cash flows. 6. Research alternatives. Before finalizing your decision, research alternative options or strategies that may provide similar benefits at a lower cost or reduced risk. 7. Consult experts if necessary. If necessary, consult financial experts or advisors who specialize in capital budgeting to gain valuable insights on complex scenarios before reaching a final decision. Capital budgeting plays a crucial role in the financial decision-making process of any organization. By carefully analyzing and evaluating investment opportunities, businesses can ensure that they make informed choices that align with their long-term goals. The benefits of capital budgeting are substantial and can greatly impact the success and growth of a company. One important benefit of capital budgeting is improved resource allocation. By identifying and prioritizing potential investments, companies can allocate their limited resources effectively to projects with the highest potential for profitability. This helps prevent wasteful spending on projects that may not deliver desired returns. Another advantage is enhanced strategic planning. Capital budgeting allows organizations to align their investment decisions with their overall business strategy. It enables them to assess how new projects or acquisitions fit into their existing operations and market position, ensuring that investments contribute to long-term growth objectives. Furthermore, capital budgeting aids in risk management. Through rigorous evaluation techniques such as discounted cash flow analysis or net present value calculations, businesses can assess the risks associated with different investment options. This allows them to make more informed decisions by weighing potential returns against possible risks. Additionally, effective capital budgeting promotes accountability within organizations. By establishing clear criteria for project evaluation and selection, companies can hold decision-makers accountable for their choices based on predefined metrics such as payback period or internal rate of return, IRR. This helps create a culture where responsible decision-making is valued and encourages transparency across all levels of management. Capital budgeting facilitates better communication among stakeholders. When making significant investment decisions, it is essential for businesses to involve key stakeholders such as executives, board members, investors or lenders who require detailed information about proposed projects' financial viability before committing funds. Effective capital budgeting ensures accurate data presentation which fosters trust among stakeholders, leading to smoother decision-making processes. In conclusion, capital budgeting provides numerous benefits for organizations looking to optimize their resource allocation strategies while minimizing risk exposure. By utilizing various evaluation techniques like discounted cash flow analysis or net present value calculations, companies can make informed decisions that. Capital budgeting plays a crucial role in the financial decision-making process for businesses, helping them allocate their resources wisely and maximize their long-term profitability. By carefully evaluating potential investments and determining their feasibility, companies can make informed decisions that lead to growth and success. Throughout this video, we have explored what capital budgeting is and discovered its numerous benefits. So start incorporating capital budgeting into your financial decision-making process today and witness the positive impact it can bring to your organization's bottom line.